Welcome to Centaur Financial Services Podcast. The information provided on and made available through this video and podcast does not constitute as financial product advice. The information is of a general nature only and does not take into account your individual objectives, financial situation or needs. It should not be used, relied upon, or treated as a substitute for specific professional advice. We recommend that you obtain your own independent professional advice before making any decision in relation to your particular requirements or circumstances.
Hi, I'm Hugh Robertson and welcome to today's latest episode where we're going to be talking about retirement age, some of the misconceptions around that, and also some strategies that we can do to unlock some wealth for you. Today I'm joined by Nick Georgopoulos and Bobby Byrne, who'll be here as our experts to uncover all the strategies in detail. But first, gentlemen, I want to start with, let's talk about retirement age. There's common misconceptions around when can I retire. So, Nick, do you want to start us off with that, please?
Yeah, thanks, Hugh. So the main three ages that we usually get asked around when retirement is, people are thinking it's either 60, 65, or even 67. So let's sort of break those down and what's significant about those ages. So if we start from the top, 67, currently that's our age pension age. So once you turn 67, you can access the age pension given your income and assets are allowing you to do so, and you can get some government support that way. If we go back down to 65, that's the condition of release for your superannuation funds where there's no restrictions. So you can still be working and access your superannuation funds. And then down the bottom, 60, that's, again, another condition of release. As long as you have retired, you can access your retirement funds. So 3 different ages, 3 different circumstances there, but it does depend on, obviously, what you have available, what your retirement plans are, the income you're really needing to determine when the right time for you to retire really is.
Yeah, and just on that as well, just to kind of further that, those conditions of release, the age 60 for super, age 65 if you're working super, and then the age 67, they're all just based on social security benefits or superannuation. You can actually retire whenever you want.
Yeah, absolutely.
If you have the means to do so. So essentially the way you kind of understand when you can retire is what income do you want to sustain throughout time, and then look at the capital you need to sustain said income. And then once you get that goal, that's essentially retirement in a nutshell. So you don't have to wait until 60, although most people do, just because of the effectiveness of superannuation and accessing it, and the way you can do that through an account-based pension structure.
So do you want to touch on that a little bit more? So 67 is age pension, which is going to be basically through the government.
Yeah.
So why would I use, if I'm a client, why do I want to utilize superannuation ahead of money in my own name, for example?
Yeah, good question. So essentially, and I had this asked the other day actually, if I had this much in super and over the last year it's only earned X percent, why wouldn't I take it out, put it in a bank account earning 4%? So there's a couple of things with that. Firstly, when it's in your own name, that any earnings on that is going to be taxable at your marginal tax rate. So if you've got rent coming in plus interest from cash, you're probably going to be in a taxable position, which reduces your overall earnings when you look at it that way. Plus, if it's just in cash, you've also got inflation risk. Right now in Australia, it's running at 6.8%. If you're getting 5% on cash, then your real return, adjusted for inflation, is actually in the negatives. So you're going backwards every year. So not ideal. Why we want to have it in superannuation? One, in superannuation is going to be invested. So that will help stave off inflation. And 2, the tax-effective environment that's in there. So once you start drawing an income stream, it's in the account-based pension phase, that's all tax-free. So no income tax, nor would there be any capital gains tax. So massive benefits there if you've held assets for a long time, and then you can sell them completely tax-free with no implications, as opposed to in your personal name. So there are risks, legislative risks and things like that, but superannuation is our most effective retirement vehicle in Australia.
And we probably think that it's a low risk that the government is going to move the age of accessing super up, considering they may not get re-elected if they do that. So so we now know the retirement ages. We know that superannuation is tax effective. So let's go into some case studies that we've used for clients over the past, say, 12 months. So one in particular is the carry forward contributions. So let's use that in the parameters of someone who's had an investment property, what they can do with that to navigate capital gains tax, which is probably our favorite tax to pay. But still, if we can reduce it, it's a pretty good thing.
Yeah, so take you back to that situation. You sell the investment property, you reduce that capital gain as much as possible, but there's usually quite a significant amount of tax to be paid at the end of that transaction. So what ways can we look at to reduce that? Like you said, that carry forward contribution option is a major one that we love to use because it significantly reduces that capital gains tax. So what is it? If we think about the two types of contributions we have, we've got concessional and non-concessional. So if we stay on the concessional side, each year you're allowed to put up to $27,500 into the concessional contribution bucket. Where the carry forward contributions of that comes into place is the amount that you haven't used between what you've contributed and that $27,500 amount over the past 5 years. The unused amount can be utilised and brought forward to making that one contribution. So, for example, over the last 5 years, if you've left $10,000 of cap space, you can make a one-off contribution of $50,000 and claim a tax deduction on that to get that capital gain tax down as much as possible.
So that's the difference between what your employer may have put in for you and that cap. Okay. So from that perspective, what are the other things I've got to consider in terms of, is there timing issues? When do I sell the property? If I'm the client right now, I'm thinking, when do I sell this property? What do I need to consider there?
Circumstantial. So if we're thinking, when does the CGT event trigger? We're looking at contract date rather than settlement date when we're looking at property. But if we're thinking, okay, the purpose of selling the property is preparing for retirement, ideally, if we're looking at retiring 1 July 2023, and we're stopping work on 30th of June 2023, if we can have that transaction occur in the following year where there will be no income coming in from employment,
great idea.
We'll be reducing down the total tax payable for the year because you don't have that tax from employment income to really account for.
There's not going to be any rental income coming. Okay, so that's a really effective way for someone to transition a big lumpy asset into the superannuation environment, which we've just touched on is probably our most tax effective environment. Not have to do tax returns quite possibly anymore if that was our only asset outside of our employment income. And then we're going to be in something that we can diversify, generate a similar level of income. So it's an effective strategy that we've certainly had a lot of clients utilize in the past 12 months. So, okay, let's now jump over to the next one. This has a few different iterations as to why we would use it. My favorite reason is to avoid a death tax. But do you want to talk us through this strategy, Bobby?
Yeah, right. So this one is called a cash out recontribution strategy. And recently, with a few legislative changes on 1 July 2022, it's come more to the forefront. So essentially, to break it down to the studs, superannuation is made up of a taxable component and a tax-free component. The taxable component is going to constitute all of the earnings in super, plus all of your super guarantee, plus all of your salary sacrifice. So most people, most of their money is going to be taxable. The tax-free component kind of sits on the other side, and that's voluntary contributions that have gone in, they haven't claimed the tax deduction for, and the like. So then we come to beneficiary nominations on your super. I'm sure everyone has one. You nominate who the super is going to go to at the end of the day. Now, there's a couple of different types of beneficiaries, but in particular, the one I want to focus on is what's called a non-dependent, which essentially, most commonly, you'd probably see as adult children for people in retirement. So they're considered a non-dependent beneficiary. Now, if the super funds pass to them, that's taxable component that I spoke about before is going to be taxed at 17%. So if there was $100,000 of taxable that went across, it's 17 grand tax you're going to have to pay, which is an unofficial death tax, unfortunately, for that beneficiary. So ways we can mitigate that is if you draw out a lump sum from super and then recontribute that straight back in, that recontributing in, because you're not claiming a tax deduction, goes towards the tax-free component. So you just increase your tax-free, decrease your taxable. So then if the funds, or when the funds transfer over to that non-dependent beneficiary, there's less tax payable, increasing the benefit they receive overall. So that's kind of where that strategy comes into place. In terms of my comment before about why that might be more relevant lately, is just because they changed the age from 67 to 75 in which you can contribute these non-concessional after-tax contributions. So the age range now is a little different and allows us to do a few more strategies just like that. So that's thinking very long term, but it's something we use quite a bit.
So there's going to be a lot of people that prior to July last year thought that they weren't allowed to put any more money into superannuation, when now they may be able to.
Yeah. So with that one, like I said before, the most tax effective environment, that's the premise. So for example, if you were 70, the year before you couldn't contribute to super this way. Now, all of a sudden you can. So previously, you may have had an investment portfolio outside of super because you couldn't have got those funds into super. Now you don't need that anymore. That can be transitioned into the superannuation environment, be completely tax-free, no more capital gains tax, and you consolidate the funds into one account, which is probably going to reduce the fees as well. So this is what we're thinking, what we're doing, reviewing people's situations. Even if you've accumulated a large sum of cash, you can still now get that back in within the relevant contribution caps. But yeah, these are things we're thinking now and doing so.
Okay, so I like the idea of this cash out recontribution. So instead of doing it just for one person now, in what instances would you do it for, say, go from take my money out of one spouse and put it into another spouse? Do you want to touch on that?
Yeah, of course. So sort of like a sheltering strategy, if you will. So when we're considering Centrelink age pension, we use this quite a lot. So if we think about pension age being 67, like we referred to before, a lot of the time we find that we might have a younger spouse. So for instance, one member of the couple is 67 and the younger is 62, for instance. If they have the same amount of assets in superannuation, that's fine. But when that older spouse turns 67, that's when they're eligible for Centrelink age pension, and their assets start to get counted towards the age pension means testing. So what's determining how much you're getting paid? So what we start looking at doing is we understand that the younger spouse who's under age pension age, what they've got in superannuation is actually hidden from Centrelink. It's sheltered. They don't count that. So on the same tone as that cash out recontribution strategy, we actually look at withdrawing the funds from the older spouse's super and contributing them back into the younger spouse's name. So effectively, for argument's sake, could be dropping assets from 600,000 down to 300,000, making a considerable difference to the age pension entitlement that they can be getting.
So now, to get the income that the retiree wants, they draw less of their own money and use more of the government's money.
Correct.
Which, if I've had a lifetime of paying tax, I'm pretty happy with that strategy.
Yeah, absolutely.
So that's not bad. That's something that, so if there's a bit of a difference in age, there's definitely a conversation to be had there around how to structure the assets.
Yep.
Okay. Let's go to something that's a little bit more complicated, a little bit tricky, and a lot of people would bury their head when it comes to this. So this is the transfer balance cap. So how do we manage differences? There's a lot of literature in our industry around the difference between pensions and commutations. So if someone's going on Google and trying to figure this out for themselves, Bobby, do you want to tell us what the transfer balance cap is, what the numbers are, and explain why pension versus why commutation, why that's relevant?
Yeah. Okay. So transfer balance cap is the amount you can have in tax-free super. So in an account-based pension, essentially. So anything that's invested in your pension account under the transfer balance cap is tax-free, which is perfect. So that right now, that cap is 1.7 million. It's about to be indexed $200,000 to 1.9 million at 1 July. So why that's important is it means you have $200,000 extra in the tax-free environment, which is going to be a significant change. So the transfer balance cap, also you have a transfer balance account, which essentially is the amount you've got in that tax-free environment up towards your transfer balance cap. Now, if you take a pension income stream every month, that has no effect on the amount you have in this tax-free transfer balance account. If you take a commutation, which is a lump sum withdrawn from account-based pension, that reduces it. So why that's important is when these indexation events happen, the amount you have in the transfer balance account under the transfer balance account will only get indexed. So it affects how much you can get in, how much the indexation will be, and how much tax-free investment you can have going forward. So it's a bit of a technical area because you have these two things operating together, but something we consider for a lot of the clients.
So what is the tax? So the amount that I can't get in tax-free, what's the tax rate that I pay if it's not tax-free?
Yep, so the remaining amount has to sit in what's called accumulation phase in super, and that's taxed to 15%. So the conversation there would be, if you've got more in super, then you can get into the tax-free environment. What's your personal tax rate? What's the superannuation tax rate? And then you've got to match up which one's going to be the best for you, essentially. So if your personal tax rate averages at 5-10%, then that's actually potentially going to be more effective than having it in super. But you have to do those for every individual.
So doing those calculations to really see if I can take advantage of that extra 200,000 index versus putting the money in my own name or in superannuation.
Yeah.
It could really make a difference over time.
Huge difference.
And especially as I get older, I would prefer not to have money in my personal name where I'm having to do a tax return every single year and then having to figure out capital gains, etc. Okay, so that one's definitely a talk to your advisor kind of strategy. We're not, we would never expect anyone to be able to understand that. Maybe our engineer clients out there. So let's now jump into something that we haven't really used since around the global financial crisis, and this was annuities. So annuities were big in 2004 when they got some very favourable Centrelink treatment, 100% asset test exempt. That went away the 20th of September 2004. You then had a few years later, you lost the 50% exemption. So that was, I think, 2007, 20th December 2007. So why, what's this annuity, coming back to life? What's happening there?
I suppose it's just the Centrelink treatment, right? So rules have changed around how both Centrelink are treating the annuities from an age pension perspective. But if we think about those dates that you mentioned before, the key thing around that would also be interest rates and actually the return you can actually get for an annuity. So if we understand what an annuity is essentially investing a lump sum into an annuity and providing yourself with a lifetime of income, whether it be indexed to inflation or to a certain rate. So for our retiree clients, it's a great investment because it provides you some secure income that you can know it's going to be relied upon for the rest of your life and really look to cover your base expenses. It's consistent, you know what's to expect in that regard. Then from the Centrelink side of it, they've started actually over the last few years now reducing what they're calculating that asset value to be. So it's at a reduced amount, which means from an asset test perspective, your $1 million going into an annuity might only be $700,000 in the eyes of Centrelink, for argument's sake. And obviously the rates that Centrelink look at that change from time to time. But definitely now more than ever, with the higher rate of interest and the return that we can get from these annuities, it's coming more and more into the conversations that we're having.
Yeah, so I'll just add a couple of points to that is exactly what you said. It works for if you're getting a part age pension or just outside age pension range, because if you have an amount you invest in there and it's only 60% asset tested, that could drop you in. And then once you get to, I believe it's age 85, 84, then it becomes even more concessionally asset tested. Then it's only 30% of the asset is tested and set against your name from age pension perspective. So it does tier up. It works for those clients in those asset areas. But again, it's so much more complexity behind the scenes in that. So don't just go dump all your money into an annuity today, because there's accessibility risk and things around that too. So speak to your advisor, I guess.
So let's wrap this up. We've talked about the misconceptions around retirement age in Australia. There is no retirement age. If you had enough money in your personal name right now, great, you can retire. But if you want the favourable tax treatment, then superannuation is the best investment vehicle that we've got in this country. From age 60, fully retired, I can access it and get into that pension environment. Age 65, if I'm still working, I can get it into that pension environment. And then 67, independent of the superannuation side of things, provided I'm within the asset test limits and the income test limits, I will qualify for an age pension. If I don't qualify for an age pension, I may still be able to get a seniors healthcare card, which is still a very valuable thing as I get older. We've then explored a few strategies around carry forward contributions, which could help navigate capital gains tax with investment property or a share portfolio. We've talked about a recontribution strategy, how that works to avoid the 17% death tax, as well as that would help a younger spouse build their balance while the older spouse would be able to qualify for age pension, which in many instances we've been able to see that could be a $100,000 a year benefit. We've touched on then the transfer balance cap, which is probably one of the most complicated areas in our world at this point in time, and annuities, which are something that we're increasingly putting more focus on to see if it's something that's going to be fit for our clients here at Centaur. So is there any other things that you guys want to add to that?
I think at the moment, with the changing environment, they're probably the things we're focusing on most, particularly with the changes in ages and contribution eligibility. So I think that's probably pertinent topics of the day from my perspective.
And pension limits coming up.
Pension limits coming up. Yeah, I mean, across the spectrum of those strategies, we're sort of hitting one of those, some of the main concerns rather of our clients, which is I don't want to pay too much in tax. I want to be able to know when I can retire and what I want to retire on, and whether or not I can get age pension, which are really huge considerations for retirees.
Okay, I think that's been really valuable. I hope you guys who have been listening or watching this get some value out of it. As always, if you've got any questions, please reach out to us. We're more than happy to have a conversation around this and see how it could apply to your personal situation. Nick and Bobby, thank you very much for your time, and thank you also. Have a good day.